And welcome back live to WomenMoneyAndPower.com. I'm Cathy DeWitt Dunn. Thank you so much for joining our show today. Well, it's hard to believe that it's already the middle of May, and a lot of people are taking a look at what they're going to be doing over the summer months, maybe going on vacation, visiting family. Well, now's the time to really take a look at your finances and get them in order before you hit the road. And there's been a lot of news that's been leaking out about potential wars in the Middle East, etc. Bruce, what's going on over there?
Well, unfortunately, it looks like our government is considering going to war in Syria. We're sending arms there. It has been confirmed that we've been supplying the rebels with arms, which is really scary. Won't go into the political implications there, but that's scary, and it has people giving the jitters. Same thing going on in the Ukraine. Nobody really knows what's going on. There's a lot of unrest there, which makes the markets very nervous.
Extremely. Well, especially at summertime when all the market makers go on vacation.
That's right.
They're not going to be looking at their positions.
That's right. They tend to take off for the summer. Things tend to cool down in the market a little bit, which in some cases in a declining market that, you could say, well, maybe that's good that they're taking the summer off. I don't think so, because then they don't react near as fast as they should when things are falling.
Well, and then take a look at what it's all over the Wall Street Journal and all these other different money magazines. I mean, it looks like the investors are turning to bonds. Why would they do that?
Well, that's kind of surprising because worldwide, this was in the Wall Street Journal last week, global bond rates fell to their lowest levels of the year.
Wow.
Central bankers signaled determination to stimulate their economies. Well, that makes no sense, because if you're lowering bond rates, you're not going to stimulate anything.
No.
That means people are not going to put money in there. But then on the same page, it says nervous investors pile into bonds. Well, they pile into bonds because they're scared. They're going to safety. However, if those rates are falling, in many cases they're well under 4% now, to me that signals that people are losing faith in the market.
Well, I mean, why would you, and from my perspective, okay, Bruce, let's take a look at this. Why would you go into bonds if you know you can get a minimum guarantee of 4% and access your money, and you don't have to worry about the bond values later down the road?
Sure, or having to sell at a discount if you had to get your money out.
Right. I mean, there's just so many great ways to make some money right now. And, a 4% minimum guarantee, thinking that this market could have a potential correction. And if I'm wrong, you also have the opportunity to make 2.5% per month. And let me just tell you some of the indexes that we're working with. We're working with the Dow. Isn't that where you have your money anyway? The
That's
S&P 500, the NASDAQ, a gold index, a real estate index. So these are all of the indexes that you want to participate in. So why wouldn't you participate in them when you have your principal guaranteed?
Correct.
And be able to make the 2.5% per month?
The only reason I wouldn't do it is because either I just don't know about it, or my broker or my brother-in-law, who I've been listening to, unfortunately, for years, has told me, oh, no, you don't want to do that. Come over here and buy brand X.
Isn't that the truth? Well, that's what we hear all the time. Or, we have a lot of people out there that are CD buyers. They'd rather sit in CDs and not make anything, but they have interest rate risk.
They like to go in and say hi to their banker and get the free coffee. And, it becomes, I can't tell you how many banks I've been in where a lot of retired guys are hanging around drinking coffee, just chatting. And, that's cool that you can do that, but why tie up your money for 1% when you can get 4% as a minimum guarantee and with the potential of a whole lot more?
Right. And then also in a CD, if you end up needing money for medical, or if you have something that comes up, if you have to break that CD to get your money, you've just, paid a fee to get out of that.
That's right.
So on this particular fixed index annuity that we're talking about, with the home health care rider, the nursing home rider, the terminal illness rider, though, if you have those issues, the contracts are 100% liquid, and you are still going to be able to receive growth of the market and principal guarantees. So
at the same time.
At the same time. So give us a call today. Find out a little bit more about that. Find out about how it has a doubler for home health care, the income. So if you're receiving $25,000 or $50,000, that number would increase, and it would be there for the life of the contract until you ran out of money. And then if you ran out of money, they'd go back to the original income payment. So there's lots of great opportunities right now. Right. So give us a call today. We'll walk you through it. The number to reach us is 972-473-4700. That's 972-473-4700. $4,700. You know, we have a lot of other strategies too that we work with, Bruce, and this one gets a lot of attention, but then we also have the one for the person who's never purchased an annuity, or maybe they got burned in the past. They bought a variable annuity. There were a lot of fees inside of it. There is an annuity that's out there that has a 5.5% guaranteed growth rate,
Wow.
and you could do better than that.
Right.
But if you don't like the annuity, in 2 years and 1 day,
You can get out.
you can get out with all of your money. And that is not a 2-year annuity. All that is suggested. Had somebody
That's
call up and says, I want that 2-year annuity. It's like,
Yeah.
no, it's not
No,
a
no, no,
2-year
it's not a
annuity.
2-year.
It's if you don't like it after 2 years, there's no penalties to
They
get
let
out.
you walk.
Right. So, I mean, there's just so many great opportunities. But that particular annuity, it's the 5.5% minimum guarantee. And you could do better because they have a monthly cap. It's around 1.79. And so you're guaranteed you're guaranteed the 5.5.
Right.
But if you perform better than the 5.5, you get to receive that as well. So
And
there's
that's over 20% potential.
right. I mean, and I think, if you really take a look at the numbers, I think you really have to position yourself to go, what are the what's the downside of it? You're probably not going to get 100% of the market.
No.
But if you could average a large share of the market and none of the down market,
And I have a guarantee.
Have
And I
it-
have access. And
Right.
if I change my mind, I can walk.
and then if something happens to you, all the money goes to whoever your beneficiaries is. I mean, that's one of the things that is a challenge on the annuities is people think, well, I gave up control of the asset to the insurance
Now,
company.
doesn't that have an increase if you did need the death benefit? Doesn't that have an increase immediately?
Oh, absolutely. Immediately payable upon death and verification. So the annuity world has really changed. And I think that's one of the things that I want to get across to everybody is the liquidity features, the growth features, all of the different features, double income, control of the asset. I mean, that's not the way the annuity world used to be.
It was not at all. And we see these companies now really having to compete for your money. And so that's why they come out with these better pay, better guarantees, better features, and all for you. And good news is we're independent, so we get to go out and pick the best ones.
Oh, that's a great point. Exactly. So we've got 3 or 4 companies today that we've talked about. Lots of good options to have some positive returns. And I'm going to tell you one thing, and I'm not here to talk politics, but Obamacare scares me only because my dad is on Medicare. He's in his late 80s. I'm seeing everything that's happening to him right now, Bruce, and all the money he's having to pay to cover his medical costs. Okay, and he's in his late 80s. What about people right now that are let's just say that they've turned 75 or just say 80? They may not have a healthcare crisis right now. They might not be shelling out a whole lot of money on healthcare, but later down the road they are. And I'll tell you what, you better be prepared to have your money in a position to be able to access it, to get it, to be able to have it grow, and to have minimum guarantees for growth because you're going to need it later down the road.
And if you're not of Medicare age, I just saw an article this week as well that Obamacare premiums, guess what, are going up.
Oh, I know.
Already.
Somebody just told me that their premium went through the roof. We're going to a quick break, but if you'd like to find out how you could earn 2.5% on a monthly cap based upon the Dow, the S&P, the NASDAQ, a gold index, a real estate index, give us a call today. Your principal's guaranteed. We'll walk you exactly through how that works. But remember, too, you have a minimum guarantee for growth and a roll-up of 4% per year. Call us today, 972-473-4700. That's 972-473-4700. I'm Cathy DeWitt Dunn, and when we come back from our quick break, we're going to talk about pensions and also your 401ks. We'll be right back.